Hi everybody. The topic today is asset-based finance. We will start by answering the basic question, what is asset-based finance? Then, for this type of financing, we will talk about the eligible asset, counterparty risk, the instruments, and finally, we'll provide some figures about the market size. So, what is asset-based finance? Asset-based finance is a fully collateralized loan. So it is a technique for companies to raise money, and the collateral for the money raised is the asset which will be bought with this money. Usually, the collateral for the lenders is the cash flow generated by the portfolio of projects of the company. In asset-based finance, the collateral will be the particular asset bought with the loan. The lender, like for any loan, needs to identify the borrowing base. When the asset is, for example, a plane, the borrowing base will be naturally the cost of the plane. However, when the asset is, for example, an intangible asset, like a trademark, the borrowing base is a little bit more complicated to assess. But it is important for the lender to know the borrowing base so that the lender can decide about the advance rate. The advance rate is the percentage of the cost of the asset which will be financed by the loan. If the asset is highly liquid, the advance rate will be high. If the asset is not liquid, the advance rate can be as low as 50%. What are the eligible assets for this type of financing? There is a broad variety of assets which can be financed, starting from fixed capital assets like planes, buildings, factories, trucks, etc., account and receivables, inventories, but also intangible assets like patents and trademarks. What about counterparty risk? Like for any loan, counterparty risk is very important, and the lender needs to assess it to be able to assess the default risk of the loan. In asset-based finance, a security interest is given to the lender. It gives the lender the right to seize the asset in case the company is unable to pay the loan. The loan contract can also include some covenants. They could be either financial or non-financial covenants, but they could also be springing covenants. Springing covenants are covenants who come into play when certain conditions are fulfilled. Credit risk management is important. However, because the asset serves as collateral, in general, no credit rating is required. This is why this type of financing is very appealing to non-investment grade firms. There is a particular sector where this type of financing is used. It is export finance. This is a way for companies to outsource the management of receivables from customers who are abroad. Some credit enhancement can be obtained through export credit agencies. The instruments in this type of financing depends on whether it is a short or medium-term financing or a long-term or capital structure financing. When we talk about short or medium-term, we think mainly about working capital needs. These needs come from the fact that customers pay on credit, there is a need for the company to hold some inventories, and finally, sales are cyclical. The salaries paid by the company are not cyclical. The cyclicality of sales versus the non-cyclicality of salaries can create a gap, and this gap generates a need for the company to raise some short-term funds. The typical instrument will be a revolving line of credit. This will be a line of credit negotiated with a financial institution, and the company will withdraw money as much as needed. Whenever the company pays back the loan, then the line of credit goes back to its initial level. This is why we call them evergreen lines of credit. Other instruments include factoring and leasing. Factoring is a way for the company to outsource the management of account and receivables. And leasing is a way to let the property of the bought asset into the hands of the buying financial institution. So what is the size of this market? This market is pretty big, and the volume was around 60 billion between 2012 and 2016. A particularity of this market is that it is heavily concentrated. For example, if we look at the market share of the top 10 institutions, it is around 80 or 90%. And the number of deals is very small, meaning that the size of each deal is quite important. To assess the concentration of this market, we can even look in deep into the market share of the top 10. And what we observe is that Wells Fargo and Bank of America are concentrating 50% of the market share. For the number of deals, they are also concentrating between 60 and 70 of the deals, given that the market deals are around 120, so they are also concentrating close to 50 or 60% of the deals in this market. Same thing for the volume. The volume by these two key players, Bank of America and Wells Fargo, is around 10 billion for a market size which is close to 16 billion. So what is the takeaway? The takeaway is that asset-based finance is a funding whereby the collateral for the loan will be the asset. It can be used either for short-term or for long-term needs. Thank you for your attention.